Welcome to the Plant Grow REAP podcast.
Welcome back to Plant Grow REAP. I'm Chelsea. I'm the host of today's episode, and I am joined by two fantastic finance experts, Amanda Byrne and Steve Lake. So Amanda and Steve work in this space every day, and today they're helping us unpack some of the most common finance myths and misconceptions that we hear from people all the time. Primarily, this episode will be about credit scores, but I'm sure there will be lots of other little bits and pieces that come through on other finance matters. All right, so welcome to you both. Thank you so much for joining us.
Pleasure.
Shall we start by just giving a little bit of background, a little elevator pitch on what each of you do in the finance space?
My role is finance coordinator with Aintree Group. So I've been in the mortgage broker industry for 10 years plus, actually. Predominantly broker support, but I've moved into broker role. And so with Aintree Group now for just on 12 months.
Awesome.
Very cool. My role is Director of Partnerships at National Lending Group, which is it's called the aggregator for Aintree Finance. So my role is to help Amanda and Aintree Finance reach deeper into the customer base to help them get the results that they actually deserve as borrowers rather than just being at the mercy of the banks.
Fair. So it is fair to say that both of you see the full gamut of everything from credit scores to the bank side of things and lender side of things. So you've got that experience and the knowledge around how credit scores work, how they impact people's borrowing capacity and all of that.
Absolutely. Yep.
Alrighty, so shall we dive in with myth number one? So something we do see a bit and we think that potentially movies, social media, things like that have a bit to do with this one. So there are people who say that we don't have credit scores in Australia. It's just an American thing. Who would like to speak to that one first?
Would you like me to have a crack at that one? All right. So I actually worked in the US in mortgages back in 2006, 2007, and they had what was called FICO, FICO, which was their credit score. Excuse me. It's called a positive credit score because it relates to everything as borrowers borrow and they repay and the way they behave. So that was brought out to Australia in terms of, we say what we called a negative credit score, which would only report bad things. But would have been 5-6 years ago now they brought in the positive credit score. So it runs sort of very similar to the US in terms of the higher your credit score, the better borrower you are, the easier it is to borrow money, and the lower interest rates you will get, as opposed to a lower credit score, difficult to get money, not impossible but difficult, and it's likely to be more expensive as well.
Yep. What about if you have no credit history? What's your credit score then?
That's a really good question. Not having a credit history doesn't really cover the whole picture.
Yeah.
So it's things like employment history as well is really important. You might not have credit history, but you may have missed, well, for argument's sake, if you've got a phone plan and it's with one of the major, like an Optus or a Telstra, and it's on a postpaid rather than prepaid, it's going to have impacted your credit score because you would have had an inquiry generated, which would have, if that was the first thing you ever did, it would have established your credit score. And then you sort of start off at a midpoint. You don't start off at the bottom. You don't start off at the top. So yeah, it's not really that big a deal to sort of think that, I don't have a credit score. I need to get some kind of credit to establish it. It's more about just getting things moving really. And lenders are very understanding of that too. If you've never borrowed money in your life before and you're going for your first home loan, which a lot of people do, right? It's not going to have the negative impact that you think it will.
Yeah. I feel like that leads nicely into myth number two, which is you must have a credit card to have a good credit score.
No.
And I can already see Amanda shaking her head.
No, you don't need a credit card. You just need to pay your bills. You just need to pay back any liabilities, so personal loans, any home loans, all that kind of thing. But certainly just paying bills on time is all you need to start with.
Yeah.
You don't need a credit card.
Yeah. And Steve, you touched on before that it's not just credit, it's also employment history. There's also like geographical location data plays a factor for better or for worse.
It does, and also things like if you move house on a regular basis as well, that will affect your credit score, right? So it's building a risk profile based around a lot of factors in your life. The reality is that outside of the credit reporting agencies, no one really knows how it works. We've got a general idea that it's a sort of an up and down system. So 3 years in the same house will boost your credit score. Less than a year in one job, bouncing around from one job to another could decrease it. All these other little things that are outside of actual borrowing can affect your credit score. So it's and having that credit card. If you can avoid having a credit card, don't have a credit card. And certainly don't get one just to get a credit score.
Yeah, and it seems to be that a badly managed credit card is worse than no credit card at all.
In a lot of ways.
Yeah, you touched a little bit on the credit reporting bureaus then. So they are the people who make the credit scores or generate the credit scores.
Yep.
So what are a couple of examples of how that works sort of in Australia?
Yeah, cool. So Equifax is probably one of the bigger ones. Equifax, Ilion, and who's the third one again? Experian. So all of them have similar yet different ways of calculating. Not all of them will calculate on all the things that are available, and I'll sort of broadly expand that on a little bit better. Like you can have a credit score of 900 with Ilion and 600 with Equifax.
Which for reference, that would put you at about excellent at one and then good for the other.
Yeah, correct, right? And depending on what bank uses which, so you might find that Bank A uses the good one, Bank B uses the bad one. And so Bank A says, yeah, you're fine, but Bank B, for just that reason, says, no, we don't like you.
Yeah.
And so it's probably, I think it's critical for borrowers nowadays. And I do this myself. I've signed up with Equifax. I do pay them, I think it's $15 a month or something for a subscription, but every month it keeps me abreast of my credit score because it is in certainly, if I'm going to practice what I preach working in finance, in my world, it's absolutely critical that I keep a high credit score. It's a pride thing for one thing, but it's also a really important thing when it comes to accessing finance. Mm-hmm. It'll stop you from doing it if it's a bad score. It'll allow you to do it if it's a good score, and it'll allow you to do it cheaply if it's a good score as well. Yep.
You just touched on one of the other myths about checking your credit score lowers it.
Yeah.
Whereas, so you've just said that you have an update that comes through once a month. So do you guys want to touch on whether or not it's true that if you check your credit score, that lowers it? And
You go.
Correct me if I'm wrong, but the soft inquiries of checking your credit score doesn't affect your credit score at all. It's the hard inquiries, those ones that you're applying for, that even if they don't go anywhere, that's what actually diminishes your ability for the risk.
Yeah.
And
so
a
hard inquiry would be like inquiring with a bank for a credit card, like putting in an application even if you don't get the card.
Yes.
Yeah.
Yes.
Simply put, if I actually check my credit score, it won't impact it. If you check my credit score, it will impact it.
Yeah, okay.
And that's probably the simple methodology. Mm-hmm. And so, but there are apps that you can have. I think there's one called Money Me, which it links up to Ilion, and you can actually get a day-by-day credit score. You get credit alerts as to whether somebody's made a credit inquiry or whether a bank's going to put a bad note on your file or has put a bad note on your file, or that sort of thing. So it allows you to really not just sort of monitor, but also manage your credit score, which is really important.
Do you think, so obviously you work in the industry, so being across credit scores is hugely important to you. For the average wage and salary earner, do you think it's worth being able to check it every day, or is it more realistic to keep an eye on it sort of month to month?
It's more when you do something, right? So if you go borrow, you'll need to check it again afterwards because it will go down. Mm-hmm. Most instances. Moving address, things like that. If you change employment, it's going to affect it. And it's probably only really relevant. There's two things. So First thing is, I would suggest that you have some kind of relationship with one of the credit agencies so that if there is an inquiry that's placed, it can help prevent identity theft and fraud. And that's a really big, that's something that's really growing now with a lot of data breaches and things like that. We see a lot of that now. Identity theft and fraud in that respect, somebody stealing your driver's license out of the mail and getting a credit card and not paying it back and maxing it out and that sort of thing. It's a long process to unravel.
Yep.
Right. It could be 2 years before you can do anything, before you can borrow or anything. So that's a really important one to have a look at. The next part of that is that, so getting those alerts to say, okay, well, somebody's put a hit on my credit file is really important. And but having just sort of checking it, I'll probably check it every 6 months if I was just average Joe Blow.
Yep.
Yeah.
Because you don't want to get wrapped up in it too much.
No, but also knowing what it is that your credit score is and what the report looks like and what is on it, because it's amazing how many clients that I come across that when you do run their report and you say, well, you've got XYZ credit cards, I'm going, oh, but we only thought we had X.
Yeah.
Oh, no, well, and we haven't used Y and Z for years. But they're still there. They're still open. So, and that is still a part of your reporting. That's still a part of what the lenders look at, and this still goes against you if you're not using them, you don't need them, close them, take them off.
Yeah.
So
I think that's a big thing that we run into where people don't realise that, that credit card that's just been sitting there that they haven't used in 5 years is still sitting on their credit report as potential debt.
Yeah, it is. Lenders will take that into consideration if you go to borrow, and it'll restrict your borrowing capacity.
Yeah.
Yep.
That leads nicely into the next one that people don't realise is on their credit score. Myth number 3, buy now, pay later platforms like Afterpay don't affect your credit score.
they do. It's still a liability. It's still a loan as such or a credit facility. So it is, yes, definitely still something that you need to consider. And honestly, the banks do not like them. So they'll inevitably most of the time ask you to close them. So they're not something that the banks or lenders like to see. And they see it as
like living beyond your means.
Yes, yeah, absolutely. So and short term all the time. If you're using it short term all the time, it does raise flags with the lenders as to how you manage your money.
Yeah, and
that's an interesting point, isn't it? Because it goes beyond the credit score, then, right? It goes into their character and their capacity to actually. That's a really good point that you don't sort of see from the outside. So it's having the banks to say, well, how do these people are actually raising red flags?
Yeah, it sort of speaks to them not being able to manage their money week to week, day to day, if they're using Afterpay for all these little things that they don't need to. And then coming and asking for more money for a house. And I think it stays on your record. It's similar way to the credit card. You can have an open Afterpay account that you haven't used in years. You might have started it because there was a promotion. I know often a bit of a trap with online shopping is you go to the checkout and they say, oh, if you sign up for Afterpay, you'll get 10% off. So people do that, not realising that then that has meant that there's a negative impact on their credit score. So it's definitely worth considering. Is it really worth the 10% off your sneakers for the hit to your credit score?
Yep.
I'd like to go into why all of this matters. So we're talking a little bit about the things that negatively impact your credit score, being across your credit score, knowing where it's at and what's going to bring it down. One of the myths is that some people think that credit scores just don't matter at all. Whereas I would say that you guys would argue that it does. Could you speak a little bit on, the impact that credit scores do have for real people all the time and why they should care about where their credit score is at?
Certainly from a lender's point of view, there's a lot of lenders out there that are now doing CCR reporting, so comprehensive credit reporting. So they look at that for their serviceability, so for their ability to pay and their assessment. So it's a really important part of the loan process to then get approval. And obviously the better your credit score is, the easier it is to to have the lenders trust that you will actually be able to pay the loan, that you can service the loan, that you are a good candidate for them to take on as a borrower.
Yep.
Just on that as well, Amanda, like it's the score is one part of the credit report, right? So do you want to talk just briefly on that sort of missed payment part and how that can affect as well outside of a credit score? Like even if you've got a good credit score, you may have some missed payments.
Absolutely. If you do have on your report, there's missed payments. Banks, obviously, the lenders see that. So it's your conduct, how you've conducted yourself with other lenders, liabilities, accounts, bill paying, anything.
Yeah. How reliable you are.
Exactly.
If you owe someone money, how reliable is it that you're going to get it, give it back?
Yes. And they don't want to see missed payments. They don't. You might have various some issues that you can comment on, and it's for some reasons out of your control, some circumstances out of your control. But ultimately, what the lenders see on your report on the piece of paper is what they're looking at as, well, are they paying? If they're not paying, why not?
So for people who are thinking of borrowing, probably speaking more to like mortgage, but any kind of big borrowing, boosting that credit score really comes down to having like really strong, stable, consistent financial habits. So if you've got a phone bill, you pay it. You've got your rent due every month, you pay it every month. You make sure that you're on top of all those payments to prove that you are someone who is reliable with your money and with other people's money, more importantly, because at the end of the day, that's what the banks want. They want to be able to trust you with their money.
Yeah, credit reporting is the transparency.
Yeah. So how is the current finance and lending landscape looking? Obviously, this podcast will come out a little bit later in the year, but we're currently at the start of 2026. So we've talked about why it is important to maintain a good credit score. How important is that at the moment with how cost of living is looking? I know that the RBA will be doing a bit of a cash rate look next month. For people who are looking to either get a loan for the first time or refinance or something this year, how is it all looking out there in your experience?
I'll have a crack at this one. Okay, so what we're obviously seeing at the moment, we're at, what are we, 13th of January 2026. All the lenders and the industry experts are expecting an interest rate rise in February, right?
Yep.
Which is completely different from what we thought 3-4 months ago. We thought we'd be getting another reduction. The critical thing for people that have a mortgage is to think beyond the interest rate and think more about how can I pay this debt off faster. I'll give you an example with strategies that Amanda's got at her disposal. You can effectively halve the life of your loan, right? So let's say you've got a 30-year mortgage on, and we'll talk around numbers because I'm not great at maths, right? So let's say you've got $1 million loan at 5%. You're probably going to pay somewhere around $1 million over 30 years in interest, right? So, and let's say, for instance, you're on 5%. With some strategies that Amanda's got, she can help you get that down to, say, 15 years, which will save you about somewhere around $600,000 in interest with the way interest works. So you'd be looking then at thinking, okay, well, if I can either sort of play the interest rate game, the race to the bottom, refinance, muck around with that, but maybe save 0.5%, which over the life of the loan is really realistically going to save you maybe at the most 50 grand, right? If you get that right. If you don't wind it back to a 30-year loan term, which a lot of people will ask you to do as well, which is a real problem, which will then extend the interest period and make you pay more. So that interest rate reduction that you've gone for is actually not only negated, it's actually made a complete negative. Or you can look at different strategies to pay down your debt fast, look at your budgeting. The structure of your loan is critical to that, which Amanda can take you through. But if you can imagine, instead of saving, for argument's sake, in cash flow $100 a month by swapping rates, you can restructure your loan. You'd actually save $500,000 in interest.
Yeah.
You tell me which one you want, right? So that's not the new thing. It's an old thing being revisited now in terms of, okay, we know interest rates are volatile. We know they're high. Historically, they're not, but at the moment, they're in this moment in time, they're high. What can we do to actually negate the impact that interest rates have? And it's by doing a debt reduction strategy that Amanda here can absolutely hit the ball out of the park with.
Yeah, yeah, absolutely. And so for people who are looking for help, mortgage broker is stop number one.
Yeah.
Do you have anything to add there, Amanda, with managing loans and strategies so that people know that they can take actionable steps to have that longer term view rather than just being really short term focused on the interest rate? Yeah.
Reviews, just bring it in, let me have a look at it. Together we can look at what it is that you have in front of you. We can look at what it is that we can do to reduce the life of the loan. We can reduce repayments, your overall interest payments.
Yeah.
So, just reviewing.
And I think clients sometimes they get very caught up in the interest rate and, I don't have the best interest rate. It's also that that's not the only thing at play. It could be that a loan or a lender with a slightly higher interest rate actually suits you much better for a variety of other reasons. And that's where, having the benefit of having a mortgage broker be able to look at all the options.
Plenty of options, absolutely plenty of options at our disposal.
Yeah.
And it's product over price, right? So the product's got to be the thing that you consider best. It's like, and it's the same thing with buying anything. Like you buy a car, right?
Yeah.
You can buy a, I don't know, $30,000 car that might fall apart in 10 years or 5 years, or you can buy a $100,000 car that might last you 10, 15, 20 years. The long-term benefit is the important thing and what the actual cost is at the end of it rather than the cost at the beginning. And that's a problem with interest rates. If we look at the cost at the beginning, we think, okay, well, that's great. But if it doesn't have the flexibility to be able to actually reduce that debt as fast as possible, then it's going to cost you money in the long run.
Yeah. No, that makes a lot of sense. We've covered a lot of different myths and misconceptions. Were there any that you guys have come across in your working lives that you want to throw out there and put on the record or set it straight?
With regards to credit score, or are we just talking in general?
Finance, credit scores, brokers, the industry in general.
Yep. So banks aren't your friends.
No. Does anyone think, as in that's the myth or that's your statement?
It's a statement.
Yeah.
The myth is, I guess, is that probably, I guess misguided customer loyalty is a real problem, right? Like we see it all the time where somebody likes Commonwealth Bank because they had a Dolomite account there 30 years ago.
Yeah.
And
that was a fantastic marketing strategy, by the way. Can I just, for that, what they did was, obviously it's not in the best interest of the customer, but they did a very good job with that. Oh,
it was fantastic. I worked in the Commonwealth Bank at the time and we used to stuff coin bags into the Dolomite money boxes and use them as footballs. So they were really good. But no, it's amazing how many times you'll be able to save somebody some money and real money, right? And they'll say, no, I'm happy with the Commonwealth or I'm happy with Westpac or whatever it may be because I've banked there all my life. I'm like, well, they won't even serve you at the counter anymore unless and if they do, it's going to take ages to get served and they may even charge you for serving you at the counter. So they're not your friend, right? And it's funny how the relationship should probably reverse a little bit. And it has a lot, thankfully, since, the mid-90s when Aussie Home Loans and Wizard Home Loans were created, which I'm old enough and you're old enough and you guys aren't. But since then it has sort of shown people that, okay, banks are there for a reason. They're not there to have a relationship with anymore. You don't have the old bank manager relationship where you could go in and ask for a loan and they'd sign it on the back of a tissue and, off you go, you got your 10 or 15 grand. That doesn't happen anymore. It hasn't happened for a long time. And you've got to make sure that you bank on your terms is the thing. So having that sort of theory that, I like banking here because I like banking here, it's like, that's going to cost you.
Yeah, like how much is that loyalty worth to you because it's going to start getting up into the tens of thousands of dollars.
It does. Like you think about it, right? If it's $100 a month, it's $1,200 a year. Over 30 years, it's over $30,000, right? That's just in the sort of that's not even including the additional interest on top of that. So you're probably talking somewhere like about 40 grand over that period, right? And not only that, you might save 5 years on your home loans as well if you do it properly. So Yeah, it's an expensive exercise.
Yeah. No, that is, a good point. So a little extra myth busted there. Banks are not your friend.
No.
And I'd like to think that as a broker that we've got the customer's best interests at our heart in terms of, once again, you went to the bank once upon a time, you had your bank manager, they looked after you, but it's not necessarily, obviously not the story these days, which you've touched on already. But as a broker, it's my duty to make sure that I'm looking after my client and I'm doing absolutely everything possible to make sure that they're getting the best deal, product, outcome.
Yeah.
But also reviewing that, looking after them in 12 months' time, looking after them in 5 years' time.
Yeah, not just setting it and forgetting it and saying thank you so much for your interest payments.
Exactly. So it's about building the relationship and having that relationship. So on top of...
In a way, the brokers have stepped in to take the place of that relationship that people used to have with the bank. Now brokers are there to make sure that you have that personal connection with someone who understands your circumstances, like you said, and can review it and have their best interests at heart. But the benefit of also the products that you're looking at aren't just confined to the one lender. There's a lot more option there as well. So it's sort of the best of both worlds.
Yes, and a bank's never going to show you how to pay off a loan quick.
No, that's not in their best interest.
No, it's not. The other side to it is that, if you're out there and you are talking to other brokers, which you shouldn't be, you should be talking to Amanda, but if you are, it's important that, if you ask them a simple question, what do they want for their clients? And if their answer is, I want to get my client the best home loan rate, they're probably not a very good broker.
Yeah.
And that sounds counterintuitive, right? Mm-hmm. But I want a mortgage broker that actually can help me get ahead in life. Because there are a lot of strategies that people can use, brokers can use, and teach their clients to actually get ahead in life. Now, the beautiful part about this is you've got the Aintree Finance, you've got Aintree Wealth, you've got Aintree Accounting, you've got the three major bases covered: save tax, create wealth, and pay off debt fast. And that's an incredibly powerful thing that you won't find anywhere else, or very few places.
I will note that we haven't paid Steve to say that about Aintree Group, but thank you, because that's exactly what we're aiming to do. It's to be able to have those, because it isn't just an isolated, siloed approach. Like, you've got to be able to look outside that.
Yep.
And to your point, that is exactly what we like to be able to provide to people, is that we can go across the bench and borrow expertise from the other areas of the business, which is really good.
And also stop from making silly mistakes as well. And they're just fundamental things that can happen. But for argument's sake, let's say I'm buying an investment property with my partner, and let's say she earns twice as much as me. It might not be in our best interest to have a 50-50 split on the title. It might be better that she actually has the investment property mostly in her name for tax benefits. But going to a normal broker, I'm going to get general advice. Coming to Aintree, Amanda can then run that by over the accounting side. It's like, okay, we've got actual advice now.
Yeah. And that holistic approach is important, because then you're not just looking at it with blinkers on thinking, we have that a lot in the tax area as well, where people just look in a silo at one particular area of tax and go, oh, great, I can save this much in this area of tax, not realizing that the implication of that is paying more tax over here. Yep. So you have to be able to look at it as a whole.
Absolutely.
Yeah. Thank you both so much for your expertise and insights today. We really appreciate being able to tap into the network of expertise, not just within Aintree Group with Amanda, but also having that relationship with Steve and NLG. It's really, really important. And at the end of the day, like Amanda said, it's so that we can give clients the absolute best and services and products that are tailored exactly to what they need. Thank you very much for joining us. I'm
Pleasure.
sure we will have both of you back at some point for another episode, but thank you for listening to Plant Grow Reap. Tune in wherever you get your podcast, subscribe, and we'll chat again soon.